Startup companies that achieve a $1 billion valuation we call unicorns. Most of those companies started with a seed investment of $1 or $2 million, and over the course of a few years, as they proved and developed their idea, their concept, they were able to generate returns of 50x, 100x. We call that venture capital investing. We also call it discovery investing. Those returns have been achieved in the publicly traded mineral exploration space. Hi, I'm George Sanders. I'm the president of Goldcliff Resource Corporation, a publicly traded mineral exploration startup. And welcome back to our ongoing series of explaining and making the case for the high investability of the publicly traded junior resource mineral exploration startup space. The unicorn starts with an idea or a concept. The search for new mineral deposits starts with the same thing. And today what we would like to do is walk you through, at a very high level, the process of mineral exploration and the points along that process where serious value can be added to the enterprise and the valuation of that enterprise reflect the new value or the risk reduction in the work. So when we start out with a concept, whether it's in mineral exploration or in robotics or in biomedical research, whatever the enterprise is, we usually start with a concept or a theory. Sometimes that is derived from existing information and existing work by others, and sometimes it is a brand new idea. And the process of going from seed capital in a startup to unicorn valuation is a sequence over time of removing the risks to the validation of the concept of the idea along the way to it being commercialized. That's the process of mineral exploration when we are searching for new mineral deposits. So we usually start with a concept. In terms of existing information, we might be at work in an existing historic district, utilizing the idea that what was mined already has not exhausted the mineral potential of the district, and so we're going to look for more. Sometimes, as a result of something that happened someplace else, we're going to look in new places for a new style of mineralization not previously recognized in that place. Nevertheless, that's the concept, that's the idea. So, how do mineral explorers go about initiating that process? The first thing we're going to do is we're going to examine the setting. We're going to put geologists in the field, have them do traverses, and make note of the rocks that they see, make note of any mineralization that they see, make notes of fractures and faults and shifts in terrain and that sort of thing. We call that mapping. And as part of that process, the exploration geologist will take lots of samples of various rock types. So what he or she are trying to do is, in the field, on the ground, they're trying to present a picture of which rocks are occurring at what angle, what are the prospective rocks, what are the ages of the different rocks, what's the fracture system, we call that the plumbing system, how are those rocks prepared for the easy ascent of hydrothermal fluids that will precipitate the minerals for which we are looking. Concurrent with that, we will do a geochemical survey and sometimes geophysical surveys. So the geochemical survey, again, this is high level, we're not going into details. For those interested, there are lots of resources available online to explain this to you in various levels of depth. Certain soil horizons are sampled and analyzed for minute concentrations of a whole suite of elements, 50 elements maybe. And these measurements occur in quite minute detail. We measure in parts per billion, sometimes in parts per million. And what the explorationists are looking for is slight, or more than slight, elevations in the general statistical background of obviously the minerals for which we seek, but also related elements. And usually these elements are those that occur around the element in question on a periodic table. And geologists can ascertain from a geochemical survey something about the chemistry of the rocks and the environment that they're looking at below surface. The geophysical survey will measure magnetic response. It will measure conductivity of electrical current, resistance of electrical current, which tells us that there is an insulator, usually silica. So that's a good thing depending on the type of deposit for which we search. Now we have a picture, we have an idea. It's kind of like we have our concept, we do a little initial test work, biomedical, we do something in the laboratory, maybe with testing on animals. We get a bit of an idea. So we overlay the geologic setting with the geochemical response and the geophysical response. If we see some commonality between those things in relation to the model that we are pursuing, now we have a drill target. This first phase in a publicly traded startup is usually funded by the insiders and their close associates and friends. Once the target is ascertained that, gee, this might be another deposit like X mine or Y mine, then we're going to advance to the next phase of exploration, which is drill testing. That's a higher level of financial commitment, and so there's usually another level of financing to raise the money to drill the first phase of drill holes. And if we've done a good job generating the target, and yes, marketing is a big part of this, so if we've done a good job of creating enthusiasm for the target, we can raise that money, hopefully at a little higher valuation level than the seed investment. We're still talking about valuations of less than 5 million Canadian, often less than 2.5 million Canadian. The biggest initial move comes on the discovery. So we have our target, we've worked it up, we think there's a good chance of finding more of what was mined or more of what happened someplace else, and so we drill a hole into the ground, and if we're fortunate to intersect a showing of mineralization, and we measure these qualitatively and quantitatively. So qualitatively, we're measuring what we call the concentration of mineral. We call that the grade. and we measure that. If we're looking for gold and silver, we measure that in grams per metric ton. If we're looking for copper, molybdenum, nickel, cobalt, zinc, lead, we measure those things in percent. And so that's an easy calculation to get back to how many pounds, and that we can multiply by an LME price and get a general idea of whether or not this could at some future point be economic. So qualitatively is grade, quantitatively is the length of the intercept, the size. Eventually, if we're successful, we're going to drill some more holes, and I'll come back to that in a second. But what we're trying to establish quantitatively, we're trying to establish a length by a depth by a width, and that volume of material will end up being our deposit. And when we have enough drill holes in that, we can do a resource calculation, and from there we would move on to the development stage of advancing our exploration startup towards being a mining company. We usually get a serious upward revaluation in the company on a discovery hole, so long as qualitatively the grade looks potentially economic and quantitatively it looks like the drill intercept has some size to it or indicates that there might be some volume. We'll get a secondary bump off that, or another lift, if you will, in valuation, not as dramatic as the first, but perhaps more important on the second and third drill holes, because what those do is they confirm our discovery, and they tell the exploration company, they tell the investors that indeed there could be a deposit here, because we've established not just the grade over the interval, but now we've established some spatial continuity to this mineralization, and that's the next step towards establishing whether or not a deposit exists. A next good leap in valuation occurs with what we would call step-out holes. So the company's drilling away, it's established some continuity, now it goes back to everything it knows about its geologic model, about its setting, about its what we saw on surface, about the geochemical and geophysical response, and we say, gee, this looks like it could go way out here. So we move the drills a little further away. If those intercepts come back with the same kind of results we initially drilled, then we get a quantum lift, because now the thing looks like it could be quite a bit bigger than we originally anticipated. Obviously, I'm oversimplifying that, but I'm doing so specifically to make the point that you can see that that process is very similar to developing a new idea in robotics, developing new software, AI applications for all sorts of ideas to disrupt energy, to disrupt transportation, to disrupt communication, to disrupt manufacturing, to enhance business processes. These are all things that are going on as we speak, have been going on for a decade, are going to continue to go on in this age of convergence. And we want to make the point that the publicly traded mineral exploration startup space is the same as those other things. The big difference is most of those other categories are restricted to venture capital companies and very high net worth connected individuals. They aren't always available to the retail investor until after they have achieved their $1 billion plus valuation. The fantastic opportunity in the startup mineral exploration space is that these companies are publicly traded with valuations in many cases under 3 million Canadian dollars. We hope you found this overview informative, and please stay tuned for further videos in our series.